Are you swamped by debt? I'd like to share with you a powerful strategy that can help you take 10 years or more off your mortgage. Hi, I'm Greg Chin, an independent mortgage broker with CENTUM Capital Lending. I'm sure you've met many mortgage brokers who act like an interest rate shop, letting you know the latest rates from a number of banks and lenders. I like to go one step further. I've made it my mission to help people get the mortgage loan that allows them to pay the least amount of total interest over the course of their loan, so that they will enjoy their home debt-free in the quickest possible time. Fact: after 10 years of making mortgage payments, you would only have paid 15% of the principal. You will pay 2 to 3 times in mortgage payments what you originally paid for your home. By the end of your mortgage, you would have paid enough to have bought 2 houses, one for you and one for the bank. That's why by retirement, even though many people have intentions of paying off their mortgage, 80% would still be making mortgage payments. I don't want this to happen to you. That's why I'd like to share with you one simple technique that can save you as much as 2% interest rate reduction. You'll be able to pay off your mortgage 10 years sooner. You will save tens of thousands of dollars interest on your home mortgage. And best of all, you won't have to change your current spending or set extra money aside. The secret: how you pay your mortgage is just as important as how much. To understand how this works, there is one feature you need to understand about your mortgage, which is amortization, the length of time it takes to completely pay off your loan and the accruing interest. The longer you take, that is, the longer the amortization, the more total interest you end up paying. Conversely, the shorter the amortization, the less of your money you spend on interest and more goes towards principal. Why? Because with longer amortization, the interest has time to accrue and grow. Interest is charged on the balance that stays in your loan on a daily basis. That means every month you pay an installment to reduce that loan, but every day the amount you owe is slowly but endlessly growing as interest is added upon interest. Imagine if you're trying your best to drink up all the water in a large barrel, but a tap which drips continuously keeps refilling that barrel. The longer you take to finish, the more water you will end up having to drink. That's what happens to homeowners who have to pay month after month, yet are charged compounding interest on the balance in their 30-year-long mortgage. Every 2 steps they take, they slide back 1. Why then do most people ask for a 30-year mortgage? Because the shorter the amortization, the larger the monthly payments needed. And most people simply cannot afford the monthly payment needed for a shorter amortization. What then is the solution? Equity chunking uses the idea of taking short-term equity loans against the value of your home to chunk down the large mortgage you have. Assuming you wanted to cook and eat an elephant, the elephant representing a 25 or 30-year mortgage, you could put the elephant in a pot of soup and wait for it to slowly dissolve as it cooks, assuming elephants do dissolve. It would take a long time, maybe 25 or 30 years. Or you could do it another way. Cut it down to size. Take a bite-sized chunk out of the elephant, chew and swallow, and when you're done, take another bite. That's what equity chunking does to your mortgage, using a small equity loan to pay down the principal of your mortgage and then pay off the equity loan within a year. This works even if you have to pay a slightly higher interest on the short-term loan, because there isn't a long time for the interest to accumulate and grow. You are effectively stopping the effect of compounding on that chunk of loan. That's why you end up paying less total interest. Compound interest is the greatest mathematical discovery of all time, said Albert Einstein. Those that understand it, earn it. Those that don't, pay for it. Using this strategy, $100 disposable income would save you 5 years of your mortgage. $200 applied could save you 9 years or more. But wait, if this strategy is so great, why doesn't your banker share it with you? Well, what's good for you, to pay off your mortgage as swiftly and inexpensively as possible, is sometimes the opposite of what's good for the bank, which aims to earn as much interest for as long as possible. This can be seen in the fact that while the economy has been hurting families like yours, banks have been making profits on credit cards, loans, and mortgages. Your debt goes directly to their bottom line. Now you know a powerful strategy that can help you take 10 years or more off your mortgage. But if you're like me and most other people, we can resist everything except temptation. So how do you resist the urge to spend more once you get more disposable income? And how do you keep on track? That's why we've developed a tracking software called Interest Blocker that will help you keep track of your income, expenses, interest, and discretionary income. It's a game plan for you. The bank has a game plan. You should have one too. You may have other questions, such as how much short-term loan should I take out? How long should my short-term loan be? What is the best way to access the equity of my home? Well, the answers to these and other questions would depend on your unique situation. I'll be glad to work them out together with you and help you take one big step nearer to mortgage freedom. If you'd like to know more about this and other strategies, feel free to call me anytime or simply fill out the form found on this website. Thank you for listening.